We try to get through this relatively quickly. If you have been, then you know we try to get this done in about 10 minutes or so, just to give you a quick overview of what's on the calendar for the week, and give you a sense of what you need to look out for, and perhaps where rates will potentially be moving for the week. And if you haven't been by our website lately, Josh has a screen up here that does give you some of the highlights of the accreditation program. And those of you that are with us that are on the accreditation program can attest to many benefits included, as well as the rate advisory and alert service that's part of what this call is about today, as well as earning your accreditation so you can differentiate yourself from those in the marketplace. All right, well, let's take a look at what we have for the week. It is, fortunately, if you were with us last week, you know this page was absolutely jam-packed, and this one not so much, which is good news. We'll take a little bit of a breather here. And in fact, if you look at that calendar, other than the LAI leading in the economic indicators that we had this morning, which, by the way, came in slightly better than expected, we have nothing Tuesday, and literally, frankly, nothing Wednesday, but the ongoing MBA mortgage apps index. So really, Monday, Tuesday, Wednesday, nothing on the agenda. Bonds will likely follow the direction of stocks. In fact, as we speak here in the last 30 minutes, frankly, maybe it's about the last hour, the stock market has turned up, with the Dow has actually breached plus 60 at the moment. Large caps outdoing financials right now, but stock market on the move up, and if you're on our service and you got an alert within the last 30 minutes as well, it told you mortgage pricing has been worsening by about an eighth to a quarter over the last 30 minutes to an hour as well. As again, if you're on our newsletter, you know that 380 on the 10-year Treasury seems to be kind of the pivot point for right now that we'll actually talk about after we get through the calendar here just a little bit. So today, if you haven't joined us in a while, what we're trying to do now is break this up into a couple different sections. We'll cover the economic calendar here. It'll literally probably just take us another 5 or 10 minutes topside. And then we'll spend another 10 minutes for you if you'd like to stay on and give you a little bit of technical analysis as to what's been setting up in the bond markets, and that'll give us some direction as to where rates may be heading, at least in the near term, and give you a broader view of where they may be going as well. All right, well, let's take a look. So really, frankly, Thursday is really the big day, as you can tell just by looking at this thing. But there's a whole lot of data that comes in Thursday relative to jobs, relative to inflation. You got some home stuff, housing prices, home sales. And so to kick off on Thursday, so we would, again, we'll talk a little bit about technical analysis after this, but just kind of watch the stock market for your canary in the coal mine in terms of where rates are going up through Wednesday. But Thursday will be about jobs. And so, starting that day, really about jobs and inflation. The jobs and inflation data right out of the gate at 8:30 Eastern Time. It's an hour before the market's open, and usually about 30 minutes to an hour before lenders set pricing for the day. You'll get the weekly jobless claims report, and that's expected to tick back this week. And it's actually, if you'll remember from last week, it ticked up again for the 4th week in a row. It was quite unexpected, so they're really expecting a reversal on that. If for some reason, if it does reverse, that would be expected. No impact to be expected here for mortgage pricing. If for some reason that jobs data comes in weak again and jobless claims are up again, that would give us some reason to push into a much lower rate environment, and we'll show you some graphs on that here in a minute as well. 8:30 PPI, Producer Price Index. So last week, this is about inflation. Last week we got the CPI data, so that was measuring inflation at the consumer level. It showed absolutely zero inflation, as was expected. That helps keep mortgage pricing in the current range. And really, as long as there's no inflation showing up, but yet we're getting other economic activity indicators that would suggest the economy's on a recovery, as long as inflation doesn't show up, mortgage pricing can stay relatively contained. And so that core index is supposed to come in pretty much showing no inflation, plus 0.1%. The risk is if for any reason that thing comes in a little hot, that would move mortgage pricing, that would worsen mortgage pricing. But we would also say since it's the PPI and not the CPI number, it wouldn't worsen it as fast as if that CPI number had come in hot. So really the difference is PPI measures inflation at the producer manufacturing level, and with the unemployment situation as it is, as high as unemployment is, most speculate that producers, even if there is some inflation at their level, at the wholesale level, it's still not being passed on to consumers. There's no pricing power yet, and so retailers and others, distributors, are holding prices steady, so basically absorbing any inflation that they might be incurring on commodities and input costs. So watch that. And then we'll get, so those are really frankly, the two most important data points you're going to get this week. How's that jobs data look at 8:30? How's inflation look at 8:30? And then the rest of the data, while relatively important, this kind of the market kind of trade around it. You'll get some existing home sales data expected to show up at 5.3 million a year, annualized run rate. You'll get FHFA housing prices expected to be relatively flat, still trending down a little bit. Friday, we get some durable goods. Again, that just shows demand for goods in general that's expected to show slightly up, and wouldn't expect that to be a market mover. It can be sometimes. And then Friday, you'll get the new home sales data, which is expected to be up as well, and still running very anemic, frankly, at 325,000 annualized units sold per year on new construction. But we would expect, if you'll remember the data from last week, we'd expect that data to start to trend up, as last week we showed new permits running at an annualized rate of 600,000. So that would start to pull that number up if that trend can hold. And so in summary for the week, we would say watch stocks. They actually are reacting fairly well from Friday's information. It's like stocks are kind of coming back, and this afternoon that's got some pressure on mortgage pricing. So watch stocks, watch our newsletter and alerts, and then really stay nimble for Thursday, because that's going to be the day, as long as all things being equal, no other disruptions in the stock market. Thursday this week would be the day that we would expect mortgage pricing to move and be relatively volatile. All right, so that is the recap for the week. Why don't we take a look at? And Josh says, yeah, you know what, Josh, there are no auctions this week. That's a good point. There are auctions every other week, so Treasury note auctions. And those of you that follow us know that those are some of the biggest market movers, and likely will be some of the biggest market movers for mortgage pricing this year. There are none this week. They're usually every week. They're actually skipping this week. And I should note that they'll announce next week's Treasury note auction supply on Thursday, and that in and of itself can have an impact as well. And so, to the extent the numbers that they throw out on Thursday, it typically has a worsening effect on pricing, relatively benign. I mean, maybe an eighth or so that you see here or there because of the Treasury auction announcement. But that'll be happening next week. And so on Tuesday, Wednesday, Thursday, we'll get some short-term duration Treasury note auctions, which probably leads traders to stay relatively nimble here going into those note auctions, frankly. See if there's still going to be continued strong demand for our notes as there were 2 weeks ago. Okay, and so we also have consumers on our service, and so one of the, we throw this out to you if you're a subscriber, you get this talking point. It's still the same, recommending to consumers that, look, the rates are historically some of the best rates you're going to get. The recovery that we're seeing in the data is truly sustainable. The mortgage rates have nowhere to go up, and so your best bet if you're getting involved in the mortgage is to lock sooner than later. And sure, you can, hang tight for another quarter here or there, perhaps, in discount points, but for the most part, take the stress out of the situation, get locked up early as possible. And then those of you, floating and trying to make those types of decisions, float or lock, of course, can use our recommendations to optimize your pipeline. But for consumers, we tell them to lock them up as early as possible still. And some of these charts will probably reiterate why that would be the case.